All right. Well, good morning, everybody. Welcome. I wanted to see who was going to be on today. I'm doing something a little bit different with Texley. We don't have a scheduled speaker, and so I really don't have a topic this morning. But the reason I wanted to see where this was at is when we originally did this, I signed up for Texley, where we would get text, and you probably still get them. And we just weren't getting the numbers like I thought. So I've kind of put that on pause a little bit, but I want to continue these calls. I think it's a great idea. Nate is the one who inspired me to do it. And it's just like everything. If you want to show up, you show up. If you don't, I get it. It's okay. But before we get started, Mr. Brian Woolley is not here. So Joe Suebert's going to chat a little bit about what's going to happen. And I told him to keep it under 2 hours. So there you go, Joe.
Am I on? Good morning, everybody. As Frank and I were talking about a little bit about it, the market rallied and everybody was so excited because of inflation numbers or whatnot. But in the actual movement of rates, it's not huge. It's a little bit. You have to remember when you get these, whether it's a Fed rate cut or you see something exciting happen in the market, it's going to be in eighths and quarters in the interest rates. It's not going to be huge swings in the interest rate. And the other thing that winds up happening is when that information comes out, the mortgage market reacts much quicker than everything else. So what happens is if a rumor is coming that this is what's going to happen, they usually have the improvement already baked in. So at the end of the day, it's already done before the information comes out. Now, what happens with the buying public is they don't know all of this until they hear it in the media. They hear it on the news. Oh, interest rates are down. And we get a flurry of phone calls, as I'm sure real estate agents do as well. If they're working with people, they're saying, okay, now's the time to get out there and try and look. I want to buy a house. I've been wanting to do this. I talked about this before with the pent-up demand. There's a huge pent-up demand out there, and there are people that want to buy houses. And we still have a housing shortage, even though we have had an increase in numbers of properties listed. But what winds up happening is they come in and then they realize that it wasn't as big a swing as it was going to be. What I want to kind of talk about is an overall thought process here. A lot of people, because they went through what we had after the mortgage meltdown, they're in their mind, they still have this thing like interest rates that's where interest rates can be. And what people have to understand is that was a subsidized market by the government. There was no secondary market in play. Nobody was buying these loans. No investor is going to buy a 2 or 3% mortgage note. They can make more money in something else. So the only ones that were buying them were the Treasury. Nobody was buying these things on the secondary market. The overall interest rate, the average interest rate over the history of the mortgage business has been 6.5%. That's your normal range. Now, if we get an improvement, people have been hoping for 5.5, and they've always said the number is 5.5, and this thing's going to bust wide open. That's a long, long stretch for a privatized market. Can we get down to 6? Can we break into the 5s? Yes, we can, but it won't stay there permanently. It'll be one of these things where you've got to be in position to capitalize on it right away if it does that. I'm not foreseeing that by the end of the year. We might see some movement down after the first of the year, but you're going to be pretty much where you're at. You'll get, like I said, eighths, quarters. A huge swing would be a half, which I don't know. We'll get that. And that's not an interest rate. That's in price, the points you pay. So that's the reality of this. When people are talking about the mortgage rates and things are better, and yes, the answer is yes, they are. Things are definitely in a positive area. We need to take a look at that. But at the end of the day, all of this has to get monetized. It has to be turned into dollars. Interest rate doesn't mean anything. What matters is what am I paying every month? And so many real estate agents today, and I mean, this has been a thing that I've drilled on for my entire career, but we seem to have gotten further and further away from this. They don't know how to sit down and calculate payments without some computer program. They don't even own a calculator. They're going to call somebody to find out what this is going to be. And then it turns into a big circus of, oh, give me your stuff before we can find out where you're at. And they don't want to do that. They want to know, what's this going to cost me? Everybody should get back into, and if you're in a management position, I would say again, you need to tell your people they need to own a financial calculator of some kind that they can calculate a payment. Because if you could sit down when you've got somebody hot on a property, and I know this works. My wife, as Frank knows, is a real estate agent. She used to be a loan officer. She carries one of these, and she does this up front with everybody. Where are you at? What are you looking at? This is where you're at. This is potentially what your payment could be. Are you okay with that? Yeah, that's right in the range. Boom. And her closing rate on people she does that with is pretty high versus, okay, well, you need to talk to a lender and we'll see what the lender says. That's never been a good strategy, because then what happens is they're all fired up in the deal. Then they talk to the lender, and then what happens? Now they're trying to sell them back on buying the house. So again, when you're talking to people about interest rates, yeah, we're in a positive market. That looks like they could be getting better, but if they start talking about, oh yeah, my uncle got a deal at 3%, I know they're going back there. That's not going to happen. It's not going to happen. So if you pitch reality, that'll make it work. Once they get in, okay, this is where I'm really at. What am I looking at to buy a house for $900,000? This is what it's going to cost you in this range, give or take. Okay, I'm good with that. You're going to have a much higher percentage of closing that person than sending it off to somebody and then having them get sticker shock and bail on you.
Okay.
That's what we got.
So Joe, let me ask you something. And I'm just a geek on financial news. What I'm hearing is that the car business has crashed.
Yeah.
That's what I'm hearing. A lot of people are going to precious metals.
Yeah.
Okay. For the gold. I know.
Platinum.
Yeah. Bitcoin, which I'm not a real big Bitcoin. I got some, but I am invested in silver. How does all of this play within the interest rate? Because I was watching Nate's video, I think this week, and it was talking about, I think, Nate, you said something about foreclosures.
I've got one in right now.
Foreclosures increasing.
We have 2 listed that are foreclosures, and I just put an offer in on one.
Okay. So does that have anything to do with the interest rates, or not related at all?
Not really. Interest rates are a product of what the auctions. What I see more than anything really driving interest rates on mortgages is the way the auctions go. Because what happens is they auction off these notes, and you hear about the 10-year and the 30-year and all these auctions, and people are buying those bonds to hold on to them as a long-term investment. Where it will affect it is more of a negative impact than a positive one, because if people are shifting their money over to an asset, a hard asset like gold, you may have heard the term flight to quality. When they're talking about the market, they'll say people are doing a flight to quality. They're bailing out of stocks, or they're bailing out of volatile investments. They want to go with something that's a sure thing. Mortgages have always been a sure thing, because it's a 30-year note. The people have a house, they're going to make the payments, and they pay like clockwork, right? So when people do a flight to quality, they go to that and they'll put their money in it because they know they're going to get a return, whatever that is.
Right.
But if this is the problem when rates go down, and this is what happened when we had that 2% and 3% market, even though that's an extreme, nobody would buy the mortgages. And when nobody buys the mortgages, if the government doesn't buy them, you have to do what to attract investors? You have to pay a higher dividend. That's going to cause interest rates to go up, to increase the return, or increase the yield to the person that's buying the investments. That makes sense? Now, that's why people are making a run to gold and silver and precious metals and Bitcoin, whether you're into that or not. But they run to that stuff because they see the values going up, and it's a hard asset they can hold in their hand. So that's the way that it will affect mortgages, and the fact that nobody will buy the mortgages on the secondary market, which then will create a need to attract more investors, which is going to raise interest rates. Nate, those properties that are going to foreclosure, when were the loans originated? Post mortgage meltdown or during the mortgage meltdown?
Post.
Both?
Oh, no, they're old. No, they're old. Yeah.
So they're low interest rates on the first?
You know what? One of them is almost a $7 million property we're getting ready to take over,
Yeah.
and we have the second. Okay.
Yeah. And the
And so
second is foreclosing.
second's foreclosure. That's the first one.
Right.
The second one is that way too. That's like
Yes.
a 1-8 property out in Highland.
Okay.
It's a big ranch.
Okay.
Okay. And then the one that we wrote an offer on, which is interesting, and I didn't look at the background, and we're working with the agent on it. We have the buyer, and it's owned by a small bank in Santa Clarita. So it's just they took and I don't even know the backstory,
Right.
but they took it back for whatever reason.
And here's the reason I asked that question. Foreclosure rates on loans that were originated in the subsidized era, the foreclosure rate on those is extremely low. You can't rent a house for what these people are paying on their mortgage. The stuff that's rolling over and going into foreclosure is a lot of second trust deeds, a lot of HELOCs, things like that. People didn't want to mess with the first. They needed money. They went and borrowed it. The rates are high or they were adjustable, and now they've gone up and the people can't swing the payment anymore.
Yep.
And the second is foreclosing on the property. That's where your foreclosure market is most likely going to come from. So if you're
All three of ours are just what you said. That's exactly
so
correct.
if you're looking for stuff to farm and to look for in that marketplace, that's going to be the hot spot. It's not going to be the guy and the gal that moved in and got a 2.5% or a 3% mortgage. A perfect analogy of how this actually works in the real world. A friend of mine, been a friend of mine forever. I actually did the loan on his house. He has a 2.4% mortgage on his house. His wife passed away and he doesn't need the house anymore. So he was going to sell the house and move into an apartment. His total payment, and again, this is why I say you got to monetize things when you're talking about to people. His total payment on that house, taxes, insurance included, is $1,600 a month.
Where's he going to rent for that? You can't rent cheaper than that.
He went and looked here in Simi Valley in a newer apartment building for a 1-bedroom. He lives in a 4-bedroom home that's 2,400 square feet. And he went and looked at a 1-bedroom apartment and it was $3,400 a month. So he said, well, I guess I'm going to keep that house. So, this is a huge, people don't realize how many mortgages were actually done during that period of time. You accumulated something in the neighborhood of $17 trillion in mortgages in that subsidized area, 17 trillion. And to try and get your head around what a trillion is, I was reading something here the other day. 1 trillion seconds ago, Jesus Christ was alive. That's how big a trillion is. So you have all of that sitting out there percolating at, between 2 and 4%. It's, unless there's a life event, it's really probably not going to go anywhere. But what has happened and what has been getting some volume is the HELOC and the second trust deed market. And those payments are adjusting, they're going up. And especially with the times that we're running into, especially with the government shutdown, they're starting to be really impacted with no paychecks and things. Those people might be the ones that are under stress.
Elgin, you wanted to chime in.
Excuse me, and I'm chiming in off of what Joe just said. I've been experiencing this for about a year, maybe a little longer, is that there's a difference, particularly when we were doing foreclosures and short sales before, and I did a lot of them, is distress sales. Because a lot of people may not be in foreclosure, but they're in distress. And kind of like what Joe was saying earlier, distress means that you might have $1 million worth of equity, but you're having difficulty making that next month's payment. You're in distress, right? The biggest difference is that they do have equity. Pilar just closed one this past week, and sure, the seller wound up getting a nice sum of money at the close, but they were in distress. You're making that monthly payment every month. It had exhausted itself. And I've had that experience a lot. So I think that sometimes with some of the people is that you can dig a little bit deeper when you're speaking with them and when you're lead generating them. And then that gives you some better options when you start talking about some of the stuff Joe's talking about, where, they may have a very low interest rate or they got the HELOC, whatever they've got. But if all of a sudden they've been laid off, or they are they have been shut down and they're a government employee, whatever the case may be, the high cost of everything else going up, where they're not able to, they're feeling the pain where they really have to sell. They just sometimes seem to want to prolong it because they've got equity. They've got equity, and the challenge is explaining that they have the equity, but the only way that you get your equity out is to sell.
Correct.
And if you can't make the monthly payment right now, refinance and put on, all that's going to do is you're really taking your own money out right now with the option of losing it.
You're
So
prolonging the inevitable is what
you're
you're doing.
prolonging it, and so I think that the language and mindset that we can put people into will be what helps us as realtors not only take the listings, but get the listings at a price where they'll move, and or people that you'll have that are on the market that are refusing the price reductions, reminding them that they have about X amount of months before they can't make the payment at all, and that the foreclosure process may be a little bit expedited because they do have equity and the bank will get paid off one way or another. So that's what I've been experiencing. I'm seeing more of that right now, even than I was earlier in the year.
I'll agree with Elgin 100%. That's what I'm seeing, and it's not as much as the people can't pay their mortgage. It's just they've got, let's say, so many credit card debts. They have medical bills. They have maybe a parent who now they're trying to take care of that's older because of the baby boomer generations. My parents in their 80s and they're fine taken care of, but there's a lot of people who have to help. So, they've got 500,000-600,000 equity, but to take out 300 grand and have another payment at 7% on a HELOC, they can't afford another payment. So they take it out to pay. So they want to sell and then rent, but then rent's high too. Right. So,
Well, and back to the original comment here, but if they haven't done the second trust deed, or in some cases, if it's been a small second trust deed, they can't rent for what their payment is now. I mean, so they're really got themselves in a bind, and they can't afford the payment they have. So, equity preservation is something that people have got to get really versed in and learn how to pitch that to people. So I'm not just here like a vulture trying to take advantage of you. I'm trying to help you save your position and get out of this hole. Because I don't think a lot of people, everyone thinks their house is the Taj Mahal and they think it's worth, millions and millions and all these other kinds of things. But I think that if real estate agents change the vernacular to equity preservation in a stressful situation, as you're saying, and talk about that as opposed to, oh yeah, your house is worth a whole bunch of money. Your house is it doesn't worth anything unless you sell it, as you said. So talking about this to people that you suspect may be in a distressed situation, I think is really a valid method to open the door to helping them preserve that equity.
Anybody else have a comment?
I'm kind of seeing, I don't know what you guys are seeing, but I know even with the rates are where they are, I still believe there's buyers like crazy who want to buy houses, and I think they will. But it seems like for me lately, the phone is starting to ring. I have a ton of listings sitting just like everybody else. I keep doing the price ranges, then a couple sell. So I'm in the same position. It looks better than it is when you're holding so many listings, but that gets expensive. I mean, just in video cost, you can be out 12, 18 grand just sitting there, So, but I am getting showings starting to happen. The last 2 weeks, the phone's been ringing. People are coming. We've got a couple offers come in. So it seems like it's maybe people will settle into, because FHA, you could still get into 5%, your FHA with a point, you can get 5.75, 5.8, so it seems like people are opening up a little bit.
Well, and Nate, you bring up an interesting point. If you stop and think about options, I'm in the world I'm in. I don't have adjustable rates to go to anymore like we used to break this up. If we had a market that would buy those, and again, the reason we don't have adjustable rate mortgages at a good, attractive rate is the fact that the secondary market won't buy them. As I was talking about earlier, there's no market for them, so nobody buys them. It puts us in what they call an inverted yield curve. In order to attract anybody to buy one, you got to raise the rates. No one will take the loan. So you've got to look at other options. You go to the things that we've always gone to in the past in a tough market. You start looking at buy downs. You start looking at permanent buy downs. You talk about paying points. If a seller doesn't want to do a price reduction, what we used to do is say, fine, don't do the price reduction because, and this gets into a whole nother thing, but it doesn't matter what the people pay for the house because they're financing it. The payment's the only thing that matters. I paid $1.2 million for the house. No, you didn't. Are you going to live there for 30 years and pay it off? No, you're probably going to live here 7 to 10 years. And you're going to wind up paying a portion of that sales price, but your cash flow every month is based off of the numbers you put together. So if the seller doesn't want to reduce the price, throw a couple of points at the interest rate for the buyer and make it more affordable for them, you're going to see that buy down was cheaper than a price reduction in most cases, in almost all the cases. I'm going to play 2 points instead of reducing it 30 grand. Or 50 grand or whatever the number is. And the buyer's happy. Everybody walks away happy. Seller got more of his money and the buyer got a better long-term benefit to him every month. That's one of the ways to get around this thing because we're not going to see adjustables come back to help bail us out on this thing. And then with the way the laws are, after the CFPB got in there and changed all the rules of what kind of loans we can offer, it's going to be limited. But buy downs, whether permanent or temporary, are a really effective way to get the buyer a payment that he's comfortable with to buy that house. And the sellers have a lot of equity and they can utilize that equity to finance that buy down to make the deal happen. So, think out of the box a little bit and get a little creative. But remember, that's why it's so important to monetize this transaction to a buyer and find his comfort zone and then target on getting him as close as you can to that. Don't worry about the interest rate. Everybody's hung up on interest rate, but interest rate differences, if you call this lender and then you call that lender and it's an eighth different in interest rate, it equates to $100 a month, as opposed to they financed a buy down and I just went from 6.5 to 5.5 or 5 7/8. Much bigger impact. I saved you $400 a month, that type of thing.
Huge. Yeah.
So, but yes, the pent-up demand, we talked about that before, last time I talked on the call. The pent-up demand is real and the housing shortage is still out there. And there's a ton of people running around that want to own a home. They want to buy a house and get in. It's just making it feel good to them.
Well, I think nobody's doing it for fun. You know how it used to be. I know it's been a few years now, but used to be you could go out and get somebody to sell their small house and buy a bigger house or from one area to the next area. And it was more of a fun experience. They were excited about it. They were gaining equity. And now every transaction is not everyone, but it's I've got one young first time home buyer and they're buying like 1, 2, 1, 3. They're financially stable. They're excited. But very few of these people are excited. Like they have to sell, they got to move, they're moving out of state. So it's like, it's like pulling teeth. So nobody's just doing it for fun. They're not excited about it,
Which makes it even more important that you make it as comfortable as possible and as enticing as possible, which is be the solution, come up and make it comfortable for them. Find out that target number, get them as close as you can to it, and you're going to have a lot better shot of getting a deal.
That's it.
Hey,
That's
Joe.
it.
Yeah.
Earlier, I think you were talking about calculators and the ability to calculate, payments. Do you particularly have any apps that you recommend? I know there's a few financial calculator apps, and there's even some that just focus on, payments calculators. So it makes it simplified.
Well, Matt, you know what? I'm old. I don't do that I actually have a calculator, and I'm like the worst thing in the world for guys when I do buy a car because I walk in with my calculator and I do all the calculations right in front of them.
Oh,
So,
yeah.
there's nothing more powerful. I don't know, I've only been doing this for 40 some years. And, one day I hope to grow up and be as good as Frank because I know he's been doing it a lot longer. But if you sit down in front of somebody and you crunch a number out in front of them, that's got a lot more power to it than, oh, let me get my calculator or my app. I use the real estate. I quit using HPs years ago. I used that real estate qualifier 2X, the board cells. That thing's a miracle. It does everything. It does property taxes, does everything. Insurance, PITI, the whole 9 yards, amortizations. And it's real easy to use and it's quick and it's fast. You just pull it out, sit down, here it is, and show it to them. And people are blown away by that someone can do that, as opposed to, oh, man, I can't get a good Wi-Fi signal. Oh, the internet here sucks. I can't get this app. Why would you put yourself in that position? Pull the thing out, bing, bang, bang, boom. Here you go. There it is.
Well, I guess I've been doing it right. If you have an $800,000, let's say you're getting a loan for 800,000 and your rate is 6%. So how do you do it on the calculator? It's 800. What's the formula?
Well, it's the loan amount, and then you're going to calculate the interest rate. But the only difference is you're going to do it as an amortized number as opposed to just simple interest. Simple interest is going to give you a number at that interest rate, but it's not going to amortize the loan. So when you use the calculators, it gives them the actual PITI. You can put in what your taxes are and all that other stuff, and you show it to them, and it's a hell of a closing tool.
So when I'm doing, I'm just giving them simple interest, but it's getting them close. So they're like,
well, you're going to be, but you're going to be, sometimes depending on the loan amount, you can be off significantly if you're using one of those, and they're cheap. I mean, you can get one for under $100, but you get in there and you punch that thing in, and there it is. And then when they call the lender, here's the horsepower in this thing. When they talk to you and then they talk to any lender and they're getting the same answer, what's that do to your credibility? Mm-hmm. You're the rainmaker. You're driving the bus. You started this whole thing. You want to be the authority in the deal.
Yeah, because I always give them a ballpark within I'm usually really, really close, but yeah, to give them a full amortized payment, just like a lender, it would take the step out.
I mean, it's so easy to do. It's so easy to do, and they're so easy to work with. Yeah, Frank.
No, Jack's got to run. I was just waving goodbye. Does anybody want to add anything before I end the call?
Maybe we'll have a calculator class next time.
I see that one coming.
Well, Brian's good at that too, but that's fine. It's easy.
That's fine. All right, you guys. Joe, thanks for running the call today. I appreciate you.
Thank you very much.
Okay, no problem.
Appreciate it. Always learn something.
I hope you guys got something out of it.
No, we did. We did.
Appreciate the insight.
Yeah, thank you very much.
Yeah, I think it helps us to think, we're not going to see, I've never thought we're going to see, 4.9 or 4 whatever,
No.
but I thought we would see some stable, hopefully 5.5s to sit, but maybe we won't, so.
As I said, the just remember, just like you, are you going to put your money, just always look at it this way. Are you willing to make a huge investment in a 2 or 3 or 4% return when you can get 5% at the bank? Well, there's your answer.
No, you get a high yield savings account at that.
Right. So not to oversimplify the whole thing, but that's really the deal. So unless you have, again, which trust me, and I know we're trying to close this, but the reason we're in the position we're in is because of what they did after the mortgage meltdown. Mm-hmm. If they would have left it alone, let it crash, it would have healed itself normally, and we'd be in a pretty normal market. But what they did is they created an environment that drove prices through the roof, because if you stop and think of what happened as a result of all of that through the whole process, the up and the crash, when you have basically the VW sign and drive loan to buy $1 million house and you don't have to qualify for it, that sent prices through the roof. Then when
we're stuck in a position where the sellers don't have to sell. They don't want to lower their prices enough to make up for the difference in the 4% or the 3.75 and the 5.75. Correct. It's that gap where we're having the struggle.
Yes, exactly.
So if the sellers would all lower, let's say 10, 15, that'd be like 15%. You'd have to be.
You lowered prices 15%.
That's what I'm hoping.
It's
what I'm hoping for. I think interest rates should stay above 6. I don't want to see them in the 5s.
Well, it's
personally, because I'm looking for deals. I'm looking for something to buy, and right now prices are too high. Yeah. Affordability is not where it should be.
Right.
And so I'm sorry, but those looking to sell, in my opinion, are going to be the ones that are going to hurt, and the rest of the society is going to benefit, just like in any downturn.
If you look, maybe these prices are going to keep going down, but they're going to go scratching and clawing all the way.
You're right, Nate. But here's the deal. And I was watching some of this on the financial stuff. You're looking at real estate's local and regional, and areas of high demand are going to be more stable than areas that are not in high demand. You're going to see in any of the what have been known as high demand areas here in this state are still going to have a lot of activity. It just depends on if the seller's going to lower their price or not. It doesn't even have to be 10%. You know, if they just, the problem we're running into right now is that we've got so many people, like I said, I'm selling, my house is worth all this money because properties are worth a lot more money. We're in a transition period is what we are. And it's the transition between a seller and a buyer's market. It's actually more of a buyer's market. The sellers just haven't realized it yet.
Yeah.
So if they get in a
It'll take them another
position,
year.
yeah, well, when they get into a position like we were talking about, where, okay, I got to dump this thing to preserve my equity, that's when they're going to price this thing. As we've talked about before with that buy and sell program, what we're seeing is that if a property is priced right, regardless of where it is in the United States, and this is houses, not condos. Condos are a problem, but single family homes, if they're priced right, they go. And here's a perfect example. I know I always refer to my wife, but it's what I'm seeing real time. She had a house over in Encino. People were trying to hold the price up real high. They were trying to get $1.2 million for it. My wife told them in the beginning it's going to go at $1.05 million. House was listed for 7 months. They finally got realistic. You know what the house sold at? $1.05 million. So, and when it got down to that, here's what it was at $1.2 million. She was doing 2-day open houses. She had days where she'd get nobody through it, and other days where she'd get one person through it. She lowered the sales price down to $1.1 million, and she had 36 people one day.
Mike, will you take over? I gotta take this call.
Okay. We're good. We're good. This was great though. I really appreciate this. Good info.
Yeah,
this is a great conversation, Mike. This is super helpful.
Joe, what did you mean by an exception on townhomes, condos? You were saying that what you were explaining was just for single family.
Depending on the region, for instance, if you're looking at Florida, if you look at Florida right now, they've got huge issues with condominiums in problems with HOAs, problems with assessments, problem with properties, issues like that, lawsuits, things of this nature. Right. That's the kind of stuff that you run into. Remember, I was talking about a national number. I'm not talking about it locally. I'm talking about a national number. But even locally, some of the things that we run into on condominiums is that they're underinsured, and they don't have the money for the requirements for Fannie Mae approval.
Right.
So they went up short of funds, and a lot of times they're underinsured. Lawsuits are not as big an issue as they were in the past. We're not seeing as many of those. The biggest thing we're running into now is insurance. It's probably number one. So that's where condos get a little bit of an issue. It's usually usually HOA issues is what causes.
That's where your buyer is going to see a spike in their HOA because of the lack of insurance
and the assessment, and then they're going to come in and they're going to have to increase it, and then you're going to see an increase in the HOA fee. Or if there's repairs or a lawsuit or something, then it's going to increase the HOA because they're going to put an assessment on there. And that's going to drive up the HOA fee every month. So that's where that winds up being a little different than the single family, because the single family problem, really, unless HOAs for single families are usually relatively low, if they have them, and we don't run into the lawsuit issue. And the only other thing that becomes an issue sometimes is the mellow roofs. But normally the single families don't have the HOA issues. And again, if they're priced competitive, if they're priced where they're supposed to be, they're going to sell because the pent-up demand is there. Like I was saying before, Frank had to bail, but that property, my wife had 36 people go through on a Saturday. She had another 40 go through on Sunday. The house sold the next week just by getting the sales price in the right range.
Right, but it had to go down 100,000 to make that happen, though.
Well, it was overpriced, and they knew that going in by at least 100,000. So. They were swinging for the fences, and they knew it. She told them that in the beginning.
Sure. Well, thank you very much.
You bet.
All right, guys. See you next week. Thank you, Joe.
Guys.
Thank you very much.
You bet. Bye.